Welcome back to the channel. Today I wanted to do a different kind of video. Generally I do a lot of portfolio shares with Composer and my Schwab account, but today I wanted to do just something related to this photograph here. It's actually from Litquidity, which is a satirical, comical Instagram page which posts humorous memes and such related to Wall Street, related to finance, and so on and so forth. And this one, actually, a friend had sent it to me, and I had noticed it myself. And obviously, because they know that I do um, algorithmic investing with Composer, so they sent this to me. Um, but it actually got me thinking more along the lines of like kind of a macro um, idea related to Wall Street and finance in general. And so basically, here you have Lex Friedman, noted podcaster. You have Andrew Huberman, also noted podcaster. Now, Lex does a lot of different things. I think he practices jujitsu, so he's athletic himself, but he does a lot of different topics. Andrew Huberman is more well known, I would say, in the fitness longevity space, kind of like a Gary Brecka, Peter Attia, Dan Buettner, Blue Zones, a lot of things like cold plunge, saunas, so on and so forth. And a very scientific guy regarding that. And then this year, I didn't know who this was before. This is a gentleman named Rick Rubin, a music producer. And kind of what they're saying, this again, this is the point of this video that I want to discuss, is these two essentially look like old finance or traditional finance that you would see on Wall Street. And then this, with the rise of quant funds, is in a way, one could argue, kind of the new Wall Street. And what they're saying with the photo is that it's sort of a very much a STEM, science, math, coder, engineer type versus, more of a jock, old Wall Street type from the 80s, 90s. So let's just kind of get into that. So obviously you see the returns here, and they're just showing, like, again, that the quant with his brain power is able to build things that outperform both sort of vanilla indexes as well as private equity funds, venture capital funds, so on and so forth. But yeah, so basically, if you look at the history of Wall Street, the history of finance in general, I would say let's take it from like 1900 to 2000. Maybe even it goes maybe 1900 to the mid 90s. Um, a lot of that was who you knew, blue-blooded, sort of private school, country club, East Coast, feeder into the Ivy League, or the sort of elite New England schools like at Amherst or Williams, internship at the big Wall Street firms, investment funds at J.P. Morgan, um, Morgan Stanley, Citi, so on and so forth, Bank of America. And then these were feeders, these internships into the jobs, and so on and so forth. And that was kind of the path. So it was the Philadelphia Main Line. It was Boston Back Bay. It was sort of old money, blue-blooded WASP. And oftentimes there was an athletic jock component. Maybe the person played football at Harvard, or they ran track at UPenn, or they played squash at Amherst, or golf or tennis at Williams. And so you can see kind of the physical side, the emphasis on the physicality, that sort of jock, athletic, fit type of sort of what I would say is the old guard, if you will. And you have this sort of genius mathematical type, um, maybe graduated from MIT, maybe spent years as a bona fide mathematician, or a software engineer doing deep dives into Python. And so, again, this is my interpretation. Maybe this is not how they're putting it out there, but this just, again, how I see things. And again, I would say if you've seen the film Great Gatsby, the old Wall Street guard reminded me a lot of the character Tom Buchanan, who was, I believe, a polo player, Ivy League graduate, old money. And again, these are people coming from math, science, physics, STEM, software engineers, and such. So yeah, it's just what it kind of shows me is the evolution. And so the power shift on Wall Street and in finance in general is away from older families, older money, generational wealth of who you know, into genius, into I'm going to use the word competence, but that sort of implies that the other people are incompetent. And it's not the case. It's a different type of competence. So a lot of these people coming out of these schools, could be highly intelligent, could be great at sales, could be great at fundamental analysis. They're going to tell you who the CEO of the company is. They're going to talk about what the company's producing, its business margin. So it's more along an MBA analyzing business results of the ticker symbol. Whereas in the quants, they're not interested generally in the company itself. This is from the book on Jim Simmons. I remember them talking about that. They're not interested in like the business side of the company, who the CEO is. They're not going to fly to meet with the CEO and listen to maybe his conference call. It's a transition from the fundamental um, stock ticker as business symbol to stock ticker as gambling chip, if you will. And and they've had tremendous success doing it. And so someone who's analyzing it as a business may have fallen behind those that are weaned more in the D, Shaw, Two Sigma, Renaissance Tech, so on and so forth. Again, this gentleman is actually not a quant. This is a joke, and these people aren't old guard Wall Street. Just want to make that clear. But that's how I'm seeing liquidity putting this out there. That transition of power um, and influence on Wall Street. So yeah, that's pretty much it. Again, just sort of a humorous little photo, and just kind of got my mind thinking, seeing that transition. I think you'll continue to see more and more of that. That power and wealth on Wall Street is going to be people who own their firms and people who have very much that STEM background and hiring people in that STEM background, not someone who ran track at Yale and can't code, doesn't have a science or math background, so on and so forth. So, anyways, that is it for today. I'll probably do a portfolio update in the next few weeks. That's it. Take care. Ciao.